So it has been quite a long session. But before we end this course, let us quickly recapitulate some of the key takeaways from what we have learned. The first thing that we have learned is that the candlestick patterns are quite an effective tool. They help us in taking buy and sell decisions when you want to trade for a short term or when you are trading in futures and options. But if you are a long-term investor, if you want to buy stocks for a long term, then probably candlesticks and candlestick patterns may not be of much use to you. And the second thing is that the candlestick patterns give you a real picture or a running commentary of how the tug of war is progressing between the bulls and the bears. The candlestick patterns do not guarantee you anything. They just tell you what is happening in the market. And then, based on your knowledge, your experience, and your analysis of the pattern, you may take a buy or sell decision. And as I always keep telling, taking a decision based on some analysis of the candlesticks, or for that matter, any statistics, is better than tossing a coin and taking a decision. The third thing what we have learned here is that we cannot trust the candlestick patterns in isolation unless the signal given by them is very strong. We always have to wait for some confirmation after we see the pattern, even at the cost of losing some opportunity. But then your wait for the confirmation must not be too long. Otherwise, you will lose the entire opportunity. So depending upon whether you are looking at the charts for 15 minutes, 30 minutes, 1 hour, or maybe 1 day or a weekly chart, depending upon what you are looking at, you have to wait for an appropriate time to see a confirmation. And then always cover your risk by appropriate means. You see, you are following, or I would say we are following the candlestick patterns. But the markets are not duty bound to follow the candlestick patterns. Markets will behave in the way they want. There can be sudden movements, sudden change in directions because of some good news or some bad news or for some occurrences in the environment. So therefore, whenever you are taking a position based on candlestick patterns, or for that matter based on anything, you must always cover your risk. If the market moves in a direction which you had not anticipated, then there must be some provision to limit your losses. Never take an uncovered position. The next thing that we learned is that based on the candlesticks and candlestick patterns, we can very well take buy and sell decisions depending upon our knowledge and our expertise. But normally, people do not go by candlestick patterns alone. Normally, you would find that people take support of other technical tools also. And then the most important thing or the most important lesson that we have learned here is that the perfect patterns are available only in the books. When you are looking at your trading screen, there you will seldom find a perfect pattern. There will always be some distortion or some aberrations, and these aberrations or imperfections must be acceptable to you after due analysis. But most important is to understand whether what you are seeing are imperfections or are they entirely wrong patterns. What I am trying to say is that if you are buying an apple and if there is a dent in the apple, then you may accept that apple with that imperfection. But you cannot accept an orange saying that it is an imperfect apple. All right. So with that, we come to an end of this course. And before I say goodbye, I would like to thank you for being with me so long. I wish you a very prosperous trading journey. Thank you very much.